as we just said earlier on the other question, you might be better off just refinancing into a new first, pay off that modest, almost paid off existing first, and then use the rest of the money. You'll get it all in a lump sum for your travel kitty, and off you go. But even that probably isn't going to be the best option when you consider the fact that whether you get a HELOC and you keep your existing, modest first mortgage, or just get a new first mortgage, you're going to be incurring a new monthly payment, and certainly going to be more than what you're paying now. And so oftentimes, maybe that's not really the best way to go. And because of the age, as we are pointing out here, just turned 70, this becomes a clear case of looking at a reverse mortgage as a potentially better option. And there's a couple things to think about. There are a couple of reasons why this might make better sense. One may be, especially if that existing modest mortgage amount that's on their home now is of a low rate, the reverse mortgage opportunity could involve getting a second mortgage. So yeah, not a HELOC, but a second mortgage. But this would be a reverse mortgage type second mortgage. We call it the Home Safe Second. What this would allow is the homeowner can keep that modest, almost paid off first mortgage, get a Home Safe Second. That can be the money they use for their travel goals. Now, that scenario, they're going to get all the money at once. So they're going to have to park it, in an interest-bearing account, or at least earning yield until such time they start, accessing those funds for their travel plans. So that's, part of that scenario. But again, the benefit of the Home Safe Second is you don't make payments on the loan unless you want to. If you don't, the interest accrues to the balance and it will grow over time. So that would be one way to approach this particular scenario. The second obvious way to go would be to get a reverse mortgage that's a first mortgage. The most popular option is the FHA HECM, Home Equity Conversion Mortgage. So you would get a new first mortgage, FHA HECM. That would be a reverse mortgage. It would pay off your existing modest, almost paid off first mortgage. And then what you would do is set up the rest of the available loan amount you're going to be getting, set it up as a line of credit so that way it's there ready for you to tap into